Good morning, everyone. I'm Steve Ankerstar, and welcome to the Ankerstar Wealth Morning Show. Today, we're going to talk about three topics. First of all, we're going to talk about the Inflation Reduction Act that was passed into passed into law yesterday, and how that can affect your certain holdings that you invest in. There's two major areas. We'll review those. Secondly, we'll talk about target earnings. They missed significantly this morning with some pretty horrid numbers. Stocks down between 2 and 3% so far, but we'll take a look at the chart and kind of talk about why it's not down more, right? And make a buy, sell, or hold commentary based on that. And then the last one we're going to talk about is China's impending collapse of their economy and how that's going to affect the U.S. stock market. Well, obviously, there's an opinion there about that pending collapse. But the question seems like a newsletter question, but I'll read you the question in full, and I'll talk about how that's not necessarily the case. And, it's not really going to affect our current investment strategy, but it could in the future, right? We'll also talk about investing in China in general. There's going to be a time and a place for it. It's probably not now, but it's coming up soon. Before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. All right, let's talk about the Inflation Reduction Act, which sure has a lot of stuff in it that has nothing to do with reducing inflation. But two major things that's in there. First of all, you can see from the headline here on CNBC, it sets the 15% minimum corporate tax rate. If you kind of remember, the Trump Tax Cuts and Jobs Act took the corporate rate from, I think it was 35% down to 21%. But there's obviously write-offs and things that can go make your tax lower than that. So it sets a 15% minimum corporate tax rate, and that's for companies, really the big folks out there, the 1 billion and above crowd. So it doesn't affect the mom and pop organizations, if you will. But certainly, I don't know, I can kind of support it you're right, we should be paying some tax for the big corporations out there. They shouldn't be able to operate without paying any. 15%, I don't know, seems like an okay number to throw out there. But but is it a headwind for your investments? Certainly. If you're invested in, Apple, Amazon, Google, all those big names, those are huge companies. I don't know what their tax rates are, but if they're paying below 15, they're going to pay more, right? So that's part one of it, and of course, that has really nothing to do with inflation. The other tax hike that's thrown into this Inflation Reduction Act law is the 1% tax on buybacks. If you think of a company sitting around a boardroom and they have extra cash on hand, they can do several things with it, right? They can reinvest it right back into the company for research and development. Improve their products and services going forward. That's kind of the standard, if you will. Or they can give it out, they can declare a dividend and reward shareholders for their, buying their stock and having the trust and confidence in the company to run things, and that gets paid out as a dividend. That's kind of a one-way door, though. Once you start paying a dividend, it's kind of hard to decrease that over time. So that's why companies are a little bit leery of setting a dividend, because then they're kind of stuck paying it forever, basically, until you get a COVID huge recession that comes through that allows them to reduce that dividend. Or so you've got, reinvest in the company, you've got pay a dividend, or you can buy back your stock, which is basically retiring some of the outstanding shares out there. It's the exact opposite of when a company is trying to raise money. They increase the number of shares, and it's literally money from thin air. And they sell these shares and they get money, and then they go forth. Well, when you're trying to be more responsible, you reduce those numbers of shares, correct? So you would retire some of them. There are people out there that think that's the worst thing since cancer. I don't get it. But, I think they should be allowed to do that. Obviously, as an investor and a shareholder in several firms, I would like for them to retire the shares, because each time they retire a share, you have incrementally a larger piece of the pie. However, the big pushback is the fourth thing you could do is pay your workforce more. So let's talk about that for a second. I know there's a lot of political opinions behind this, but in my opinion, in a capitalist society, there's folks that are out there, willing to work, and there's people that are willing to hire them, and the natural market forces tend to set the rates at which everybody is happy. Employees should feel that they're earning a wage that is represents their contribution and their experience and maybe their academic pedigree, if you will. All of that has to be a good deal for the worker, for them to say yes to that arrangement. From the employer perspective, that person that you hire needs to generate more value to the firm than what you're paying for them, right? Because if that gets out of whack, you will be out of business. So you can't just arbitrarily pay your folks more if they're not worth that. So obviously that's the capitalist take on it. The other side of the issue is, people need money to live, and people shouldn't have to work below a certain level. That's how we got the minimum wage out there. I think the minimum wage is fine. I'm pretty happy that it's not being raised, through the roof, but I think a minimum wage is fine. But just saying that you need to, just because inflation happens, employers now need to pay their people more, that may not work, right? Because it has to work for the business, can't just work for one side of that equation. So that's kind of the issue at hand that's been politicized out of this, and why you're seeing this show up as a 1% tax on stock buybacks is these the folks that are passing this, largely the blue wave, right, are saying you need to pay your folks more. Well, they can't legislate that into law. So they have to try to tell you what you can't do with your money, hoping that you will turn around and pay your workforce more. I cannot imagine that is going to have any effect whatsoever on wages and wages increasing. So and they're saying, well, this is going to generate so much revenue. It's like, no, not true, because companies will stop buying their stock back, right? They'll just pay it out in a dividend, and you did that, right? So kind of some intro, there's like 100,000 other interesting things in the Inflation Reduction Act, which is being covered widely by the mainstream media, but those are the two things that are really affecting investing out there. Are they huge headwinds for the stock market? Not really, just things we don't like. Right. It's more government hands inside of companies trying to figure out what they can and can't do. And that generally puts a headwind on the profitability. All right. Next topic is Target. What's going on there? They whiffed earnings pretty bad. And the numbers are down here. Here's the article. Stocks almost off almost 3%. Here, this line I have to think is a typo, but this article's been out for over an hour. And with it, I just can't believe this is true. It says Target on Wednesday said its quarterly profit fell 90% from a year ago. How could that even be possible? That has to be a typo, right? 9%, maybe 10%. 9 times 10 is 90. Did somebody slur the 9 to 10%? I don't know. How do you fall 90% from a year ago? I don't remember anything going on in, let's see, this would have been quarter 2 of 2021. I mean, sure, things were snapping out of COVID, but really 90%, if that's true, you'd imagine the stock would be down like 30-40% today, but it's not. So there must be something, or maybe it's fun with numbers where they were up by a few pennies and it went off by a penny, and I don't know, you got this weird relationship. So like, they missed they made 10 cents and they went down to 1 cent. So even though it's only a 9-cent move, it reflects a 90% drop. I don't know. But the problem is when you really look at the bottom lines here, so the earnings per share, the hard numbers from the 3-month period ending July 30th is 39 cents in earnings versus 72 cents expected. Rough math. I don't know. What's that? 40% miss. Again, the stock's down 3%. Revenue is in line though. And, 3 parts of earnings, their forecast is they kept their forecast the same. They blame it all on inventory and basically marking stuff down just to move it, to make room for the upcoming seasons. So I don't know. We'll see. Why is the stock not down further? Well, look how far it's down already. That'll tell you why it's not really down further. When you look at the last earnings release, when they were at $215 and you woke up the next morning and the stock was down at 161, excuse me, they just got crushed in the last earnings. So they've already been crushed. So this is kind of like it tried to climb out of the hole, if you will, up to 175 or so, and it's getting hit today. So overall, is it a buy, sell, or hold? Well, if you're a Target believer, you can hold on here. I mean, it's 2.4% dividend, 15 PE. That's fine. Am I going to go out of way personally to buy retail heading into this recession? If it's officially called that? No, I'm not loading up on retail. I like Amazon, and that's about it. I'm okay with Target and Costco if you want those, or if you want to get in a discount retailer. They tend to benefit, tough times, Dollar Tree benefits, that sort of thing. I try to kind of stay clear of most of that space, but certainly if you want to take a position there, Target's not a bad one. It has been beat up by the rest. And again, their forward guidance is they're saying this is a one-time thing with inventory. So going forward, they're going to be much healthier. If you believe management, you could also buy Target here. All right, the last one. Let me read this question to you. I have to pull it up here on my phone. The question is about China. So here you go. I've heard recent news regarding impending economic collapse in China due to a huge downturn in China's property market triggered by a Ponzi scheme by real estate developers. Wow, there's a lot to unpack in that sentence. If that happens, it will have an impact on the U.S. stock market as well. Okay, I agree with you, but that is also an opinion, not necessarily stated as fact, though. But what is your take on that, and how much impact does it have on your current investment strategy in general? None. So that's all we have for today's show. I'm kidding. I'm not going to completely blow off answering the question, but the answer to the question is none. Impending economic collapse of China. What? Okay. That's why I say when this is a newsletter article, remember there's financial advisors in the world that are like licensed and out looking out for your best interest. And there's are those that live in the financial world for 5-6 decades that do nothing but sell things to you. And I think this is one of those. It's my opinion. It'd be like, would you get on an airline with a licensed pilot? Yes. Would you get on an airline with somebody who says, I know a crap ton about aviation? No. So anyhow, careful what you read. So do I think there's an impending China economic collapse? No. Do I think there's a Ponzi scheme being run by real estate developers? No. I think they're looking out for their best interest and, doing their best, right? But no, I don't think there's facts to support really any contention behind that. But to answer the question is, if there was an impending economic collapse in China, yeah, that would have a huge effect on the U.S. stock market. Is it time to completely revamp the portfolios? Maybe, maybe not. If it's going to bring the U.S. to its knees, then yes. If it's just going to be a temporary setback for a quarter or two, then no. You do like we do any bear market strategy. You're going to get out of speculative stuff, hold some extra cash, go into some more fixed income type stuff, and hold your best to breathe through the downturn and load up while you're in the bathtub, right? Or while you're in the downturn, because you don't know exactly when it's going to be over. So that's what I have for that question. Overall, though, I think the better learning point from the question is just as you read things, and especially the holy crap, the government's coming for your IRA articles. I get, a couple of those a week. Get out of the market now. All that. That's just financial nonsense. And there's also, financial nonsense to the upside too. You can be in the middle of a, bear market and somebody's like, S&P is going to double by the end of the year. Okay, well, no, it's probably not. Right. So the extremes are what's gets the media attention, whether it's, getting your attention through some sensationalized headline or to get on TV to get people to argue with each other to get viewers. So just be careful with that stuff. And when it doesn't make sense, then it probably doesn't make sense. Right. So have a common sense approach to things. All right. So thank you so much for your questions. I do appreciate it. Now, I do want to show you the K-Web chart. Is it time to invest in China? Well, here's your 5-year chart in China, right? If you'd invested any time in the past 5 years in China, you are down money. Okay, I have to caveat that with except for March 13th of 2022. You'd be up from that point. But, really, when you look at this chart, anybody who's taken a stance before the downturn of 2022, you're down money. Right. So will it come screaming back? Well, look at 2020 and COVID, how it came, basically more than doubled in a few months. I think there's a lot of, this is K-Web we're looking at, which is Chinese technology. I think there's a ton of money to be made there, but there's also a ton of risk. So don't take the risk if you can't handle the results. Obviously, it's gone from 100 to 20 something. So the pain has been there, but that's also the time to load up on things. So I'm a big believer in China's economy. I don't think it's on the impending collapse. In other words, I think once the government kind of backs off, they'll be able to grow an insane amount. And I certainly want to have money positioned behind that. So that's my take. But again, it's high risk. I'll own that it's high risk. So don't go down that road if you're not willing to accept the risk. All right, so that's all we have. Thank you so much. Please submit your questions through email or through our website. Don't forget to like and subscribe. And that's all we have for today's show. I'm Steve Ankerstar, and we will see you back tomorrow. Bye.